Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Thursday, June 6, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we take a look at the action from yesterday and try to get through some of the stuff we're looking at this morning. Yesterday, first off, ADP employment report came out. Honestly, it was about as good a report as we could have expected. There were positive jobs. I think the jobs came in at 152,000. Market was expecting 173,000. So it was positive, but it wasn't hot. It wasn't hotter than expected. So it gives the Fed a little bit more flexibility in terms of not worrying about the economy at this point overheating. In fact, I've talked about it here on the show quite a bit, but I'm seeing signs of the opposite, where it looks like things are cooling off and the economy is still resilient, but weakening. Some cracks in the foundation and so forth. So next week's meeting with the Fed, which is Tuesday and Wednesday, I think is going to be very, very interesting, especially given that we're going to get the May CPI report on Wednesday morning, right before the Fed announcement on Wednesday at 2 p.m. So there's going to be a lot the Fed's going to be discussing. Another huge report is tomorrow morning, Friday. That will be the non-farm payrolls for May as well. And so what are we going to see there? Are we going to get something similar to what we saw with the ADP report? That's kind of my hope. Come in just a little bit below expectations, but still positive. I don't think it would be a good thing to see a big, huge jobs report. I think that would send the yield back to the upside again, and probably limit, the flexibility of the Fed. So I do think tomorrow morning's report is going to be big. We'll see what kind of reaction we get from that. And then also, of course, we want to see what happens with the Fed meeting itself next week. So the next 4 or 5 days going to be some pretty important days for the market. The good news is we set new all-time highs yesterday on the S&P 500 and on the NASDAQ. The bad news is that we're seeing more of the bifurcation that we saw back in the first half of 2023 when we saw the FANG stocks, or Magnificent Seven, whatever you want to call them, leading the market to the upside. We are clearly seeing that again. Yesterday, Semiconductors made a big move to the upside, breaking again to another new all-time high, and that carried the S&P 500 and the NASDAQ with it. But we left the Dow behind a little bit, and we certainly left behind mid caps and small caps, which failed to, they rallied, but they've just failed over the past 3-4 trading sessions to really keep up with the S&P and the NASDAQ. So got some work to do still on the mid caps and small caps. The Dow, which had hit over 40,000, as you may recall, 10 days ago or whatever it was, has pulled back quite a bit, but now trying to regain its footing and move back to the upside. But it's nice to see the semiconductors. I mean, that is a group that literally can carry the market on its shoulders almost all by itself. And that's in essence what happened yesterday and what's been happening recently as the semiconductors break out again. NVIDIA, absolutely on fire. Passed Apple yesterday as the second largest company in the world, trails only Microsoft, and it won't take a whole lot to get past Microsoft. So NVIDIA, with this massive run that we've seen since the bottom from the cyclical bear market of 2022, when NVIDIA was trading just a little over $100, it's now over $1,200 and just continues to just tack on more and more market cap every single day, getting very close to becoming the most valuable company in the world. So anyway, that's kind of in a nutshell what we're looking at. I guess we'll take a look at the market and get a closer view of what we saw yesterday. As I mentioned, Dow didn't exactly keep up with the S&P 500 and the NASDAQ, but it did finish higher. It was up 0.25%, gaining 96 points, finishing at 38,807. That is right back in to this range of where its current moving averages sit. So we got both of those. And as I mentioned all the time, when you are constantly going down below the moving averages, above, back below, back above, back below, and now here we come again, that is a trendless market. I mean, that's the definition of a trendless market. So I think the Dow has still got an upward trend because of its prior trend. But the sideways consolidation, we'll just have to see whether or not this breaks to the upside. Historically and typically, it does break to the upside. Normally, when we go through a period of consolidation, we will break in the direction of the prior trend, which in this case, you can see was clearly higher. So I do like what's setting up here on the chart, but certainly the Dow at the same time is not keeping up with the S&P 500 and the NASDAQ. S&P 500 gaining 1.18% yesterday, almost a full percentage point higher than the Dow Jones. And check out the breakout. Close was at 53.5403. I believe that candle body on that bearish engulfing candle that we saw a couple weeks ago, talked about that really isn't negated until you break through it. Well, we broke through it. The open on that day of the bearish engulfing candle was right around 53.40. I think the intraday high was maybe 53.41 and change. So clearly we had a breakout, 53.5403. This comes on the heels of pulling back, putting in a nice hammer on the 20-day moving average, and then breaking out again. This is what we typically do during uptrends. So as many bearish secondary signals as you might be seeing or that I might be discussing, price volume is the number one indicator. That is our primary indicator, the only primary indicator that we have. And it's breaking out again. We cannot fight that. And shouldn't be trying to. I think we were on the verge recently and still are a little bit on the small caps and mid caps of breaking below some key support levels. We'll see if they hold. But for now, I mean, like I said, it's difficult to bet against all-time highs. NDX, NASDAQ 100, same thing. Breaking out to all-time highs, closing above 19,000 for the first time. Gaining 380 points yesterday, over 2%. That is a massive move to the upside. And like I said, it occurred with semiconductors really leading this push to the upside as well. Breakout above that bearish engulfing candle, just like the S&P 500. Really nice move. Now, some might say, hey, look at this, higher price, lower PPO, negative divergence. Well, look at that PPO just starting to turn up. I don't know where this rally goes. If we fail, if we gap up. Actually, we didn't even talk about the futures this morning. Let me give you those real quick. The diamonds right now down fractionally, down 0.05%, so 0.05% or half of 0.1%. The S&P 500 is completely flat right now. The spider down 2 cents, 534.61 from yesterday's 534.63 close. The QQQ up 0.1%, so trying to extend yesterday's record high, gaining 48 cents in the pre-market right now on the QQQ. And then the IWM down about 0.5%. So that's the big laggard so far today. IWM back down just a little bit below 204 at 203.98. And we'll look at that one in just a minute. But really that 200 to 202 range is what I'm watching on the IWM. So let's move on. Mid-cap. Mid-cap up 1.05% yesterday. So a nice day on the mid-caps. Right back into the middle of these moving averages. 50 days at 29.50. 20 days at 29.61, and we closed at 29.51, right in between both of the moving averages. But like I said with the Dow, same thing here. It looks to me like a trendless market environment for the mid caps after a very, very nice run at the beginning of the year. So I don't know if this is doesn't look like quite equal highs, but if you treat that as essentially equal highs, we have an A, a B, a C. Potentially this double bottom here, this short-term double bottom could be a D, and then a breakout to new all-time highs would be the E in an A, B, C, D, E ascending triangle pattern, which is bullish. And the reason that it's bullish, when you get a triangle after an uptrend, that is a continuation pattern. And the whole idea is it's continuing the prior trend, which in this case is higher. So still bullish chart configuration, even though we're seeing lagging relative strength versus the other indices. Same goes with the IWM. Not quite as high and clearly not equal highs, but right now we do have the higher lows. We also had a prior uptrend, although that's not quite as clear as you can see on the other indices as well. but we did go higher. We did form what looks a little bit like a cup, maybe into a handle, or maybe it's the start of a triangle ABC. Maybe this is setting D before a big breakout. The breakout occurs 211, 210, 211. I'd really like to see it close over 211, get some volume coming in. That would be the bullish view here. The bearish would be losing, first of all, in the near term anyway, losing about the 200 level. You can see back at the beginning of May, we did have a gap up on the IWM. We never really went back below that. Right now, or yesterday, we were testing that upper end, that upper gap support, and rallied off of it. But like I said, we're down about $1 this morning in pre-market on the IWM. So not out of the woods for sure. Watch that 200, 202 support area. And then again, to the upside, you got the 210 high here, the 211 high here. Breaking out above both of those is really what we want to see on the IWM. Moving on to the, or actually, no, I didn't do the transports. I'm sorry. I always like to look at the transports. Transports yesterday up 1.18%. So we did move back to the upside, still below that declining 20-day moving average, though. And when you look at the transports relative to everything else, at least in 2024, we see an area of the market that has been lagging badly. Can we make that move back to the upside? I don't know. We'll see. Got one of the surprise groups, though, among our leaders in the industries yesterday. I'll talk about that in just a second. But that's in that transportation space. Technology. There you go. Technology up 2.25 yesterday. Back near that high 215.81. We were just a little bit above that before. Then we've got the XLC, Communication Services. Remember that long-term top that we talked about at 84? Well, we closed at 84.94, had an intraday high up above 85. Looks like it made that breakout yesterday. Really looking good on the XLC at this point. And by the way, that PPO on the XLC also making that little breakout there and accelerating to the upside after getting a center line test. So bullish momentum, in my opinion, is accelerating. I don't look back at these prior highs after I get a reset. So PPO looks great to me. Industrials struggling along with the financials, but not breaking down. Watch this 120 level. This, I think, is a classic sideways consolidation. Maybe it might be an ascending triangle. We have to see if these lows hold, but move up. You got the high here. You come back down. Looked like it might have been a cup, but the problem is this handle got too deep. Handle should not go below about 50% of the depth of the cup. I mean, that's kind of, I don't know, that's just the kind of what you want to look for in these patterns. When they start to break below 50% of that depth of the cup, it probably is going to be some other kind of a pattern. In this case, it could be sideways consolidation as long as 120 holds, or if the 121 area holds from just this past week, then we could have an uptrending line here to go with equal highs at the top, and that would be an ascending triangle. So A, B, C, D, and then a breakout above 127 is what we'd be looking for. Semiconductors up almost 5% yesterday. You know, everyone wants to always call a top in semiconductors because, oh, they're overbought. They're, RSI probably well into the 70s, maybe in the 80s. I don't know. Overbought can remain overbought, especially in a secular bull market advance when you're getting all-time highs. So I would not be trading off of overbought RSI or overbought stochastics. I think that's a mistake. I think it gets you into a lot of trouble, and you miss out on a lot of secular bull market rally when you do that. Semiconductors up 855 points yesterday to 18,737, all-time high. Beautiful move, and it helped to carry the technology group. Also, note down below, this is not gap ups and no follow through. I mean, this is a concerted move to the upside, even throughout the trading days, closing on or near highs as we see that AD line moving up. And as we go back, if you look, there's the XLC. Look at that AD line. It's absolutely awesome. Technology still a little bit below where it was back in April before the dip that we saw. So still a little bit of work to do there. If I go back to these other indices, you can see even though the Dow's well below 40,000, its recent high, AD line getting ready to break out. S&P 500 already broken out. It actually broke out before price broke out. Same with the NASDAQ. We've been going up here for the last 2 or 3 weeks with new highs on the AD line, making a new breakout today or yesterday on the price action. Mid caps kind of going sideways, but with the market pulling back the last 2 or 3 weeks in that area, going sideways isn't a bad thing. Small caps, a little bit more damaging, I think, on the AD line. We're still not seeing that IWM. I think we're still waiting for that Fed commitment, in my opinion. But perhaps even with that, maybe the IWM, maybe the small caps are going to continue to lag. As I've said before, I'm overweighted the IWM relative to the QQQ and the SPY, but I keep them all. I mean, in a secular bull market, we have rotation. It's really hard to predict exactly when one area of the market's going to lead or one asset class is going to lead. Right now, IWM continuing to lag, which is against what I was looking for this year for sure, but the year's not over. So I'm still giving it some room to recover back to the upside. I will admit, though, the last 2 or 3 days, not so much yesterday, but 2 days before, very disappointing in terms of action on the IWM, given the falling 10-year Treasury yield. And then here, transports, this is going down, and you can see the AD line going down with it. So not a whole lot to like there. Anyway, getting back to these industry groups, that was semiconductors. The electrical components made a big bounce after breaking down below the 50-day moving average, jumped back up above it, gaining 2.22%. This was one of the areas we featured yesterday in our live trading room and talked about. One of the best stocks within this group has a very high scooter. It's in our model portfolio. It is CLS, Celestica. That was our trade, one of our trades in our trading room yesterday. The stock absolutely exploded back to the upside and back above its 50-day moving average, similar to the industry group itself. I'll show you that chart in just a second, or a little bit later in the show. Internet also having a strong day. So these were among the leaders. These were not necessarily the top three, although semiconductors definitely was number one. We had some other groups, but I just wanted to point out the internet group because we're challenging that all-time high on this group. And when you get semiconductors going, and then you can look at, something like the internet group, we know Apple's getting back closer to an all-time high. These are the things that help to fuel that NASDAQ index and S&P 500, but maybe to a little lesser degree. So these growth areas, these growth names continue to perform well. And as I've talked about at the beginning of May through August is when they tend to perform their best. So we'll see if that, historical fact continues, or actually not really historical. Well, it is a historical fact, but it's more of a historical trend. I don't use it as a guarantee that this year it's going to work. But historically, throughout this secular bull market, these 4 months, May, June, July, August, 4 best months of growth stocks versus their value stock peers. Okay. Anyway, so that's a quick update there. Let's go over to the 10-year Treasury yield, and we will zero in on this. Let me get a quick update, though. Right now, it's at 431, so it is back up 2 basis points after a pretty steep drop over the last week or so. You can see 5 straight red-filled candles. Yield going down, that means that bonds are going up. Why are folks pouring into bonds, at least over the last week? Why are we seeing this? I can tell you it's not because they're worried about inflation. When you are worried about inflation, you sell bonds. You don't want to be in bonds. And the reason is pretty simple. If inflation is going to be 6% and you're holding a bond that's yielding 4.5%, you're losing money. So if you're really worried about inflation, jumping back up similar to what it was a year or 2 or 3 years ago, this is not what would be happening to the yield. The yield would be going up. We'd be seeing breakouts. This past week or so has been the exact opposite of that. And the thing was, this is kind of a interesting thing that I've been watching, because I always look at intermarket relationships to kind of help fill out the story. I mean, I could just look at the bond market, the yield. I could just look at the S&P 500, but a lot of times it doesn't tell you the whole story. And you need to look at intermarket relationships to get a better feel for what's really happening. And when we started going down at the end of last week in this, or at the end of May and the end of last week, we saw small caps moving back to the upside in a big way. Small caps were doing really well. Looked like maybe we could even get a breakout in the small caps. I think we were trading back up to 208, 209, something like that, getting close to that 210, 211 area. And then as we kept falling, all of a sudden, small caps weren't working again. And small caps were going right down with the yield, which if you followed the relationship between the 10-year treasury yield and the IWM in 2024, you realize that there's been a very, very strong inverse correlation. So when yields go up, IWM goes down. When yields go down, IWM goes up. And it's been almost every day, it seems. Since last Friday, or at least the beginning of this week, the first 2 days where we went down on the yield this week, the IWM went down with it. And, I'm seeing the transports rolling back over and going down. And I mean, to me, when transports are going down, the IWM's going down. Remember, IWM is small caps, stocks that do almost all of their business in the US. So they are domestic companies. They're not multinational companies that get profits from around the world like companies on the S&P 500. So when you're looking at the IWM and it's falling and transports are falling, it gives you a sense that the market is beginning to worry more about the economy here in the US. And so that's kind of why I want to see the jobs reports come out positive, but maybe not quite as high as expected. You almost want this perfect storm building for the Fed, where they can kind of conquer inflation, or at least to the degree they want to conquer it. I don't know. I guess to me, 6.7 annual rate of core CPI down to 3.4. I mean, when your target's at 2, I think you're heading in the right direction. But the Fed's still talking about, oh, we need to see more. We need to see more. We need to see more. Anyway, I'm not getting into all that. But I do think this Fed meeting coming up is going to be very interesting, because if we are starting to see the economy weaken, is that going to be enough evidence for the Fed to say, you know what? We think inflation is under control. It's been coming down. Now we've got a weaker economy, which is kind of like water putting out the inflation fire. I mean, if you got inflation, but demand starts to increase or decrease and the economy starts to weaken, that kind of takes away from the oxygen of that fire, that inflation fire. So anyhow, we'll see how it all plays out. I said long ago, I think the Fed should cut in June. I think they should cut a half basis point. We'll see what they do. I don't know what they're going to do. The market does not believe they're going to cut. I think market is probably looking at maybe September as a first cut possibility. I'm not going to back off of my prediction for a half point drop coming up next week. Don't think the Fed will do it, but I still believe that's what they should be doing, given the economy. I don't think the stock market, when you're talking about all-time highs, is pricing in the possibility of a recession. And if the Fed keeps rates up too high, too long, and we're seeing some of the foundation, some cracks in the foundation right now, they may work their way right into a recession. And watch the growth stocks, because the growth stocks right now are leading. They're not going to be leading if the market starts to believe that we really have a recession on our hands. So if all of a sudden we start seeing rotation out of those growth stocks and we do see a drop, that would be more of an indication to me that the market is starting to move away from the inflation fears and moving more toward recession fears. But anyway, something I like to look at, and I always like to look at the intermarket relationships to try to, like I said, finish the story that the main charts are telling us. All right, S&P 500. What I'm going to show you today are weekly charts. So instead, I always have the daily chart. But if we look at this, we can see clearly we're trending above that 20-week moving average. I mean, this is what we do in secular bull market advances. Look at 2020 all the way through 2021. Now, that was a massive rally. I don't expect that kind of a rally. It was coming off of the pandemic lows. But I wouldn't be surprised to see us continue for a while trading above that 20-week moving average, unless things start to change, more toward a recession or something like that. As long as we keep trending above, like we did in 2021, above the 20-week moving average, I think that's a good thing. The April weakness that we saw, a lot of folks thought it was going to morph into a lot. All it did is test the 20-week moving average, and now we're right back to all-time highs. As I say, don't bet against a secular bull market. Ignore what CNBC is saying, all the doomsayers that They always talk bad about the market. Nothing ever changes. When the market's going up, they're talking about some of the things in the background that could go wrong. When the market goes down, and then they're starting to talk about a crash or a recession or a correction or a whatever, bear market of some kind. Ignore it. Follow the charts. There is nothing more bullish than price action that is bouncing off of key moving averages and moving up to new highs. And then now you might say, well, look at this. Higher prices, lower PPO, negative divergence. And I'm going to tell you the same thing I always say. Secondary indicator. That's not your primary indicator. So go back here. Look at what happened for another 7 months after we started to see negative divergences on the weekly chart. This isn't a, oh my gosh, let's jump out now. You need to see price confirmation. We need to see selling. You're trading at an all-time high. That's your number one primary indicator, or your only primary indicator. Anyway, NASDAQ, looking at this same deal, almost the exact same kind of chart. Look at this. PPO here. Prices keep going up. Now we go up again, another negative divergence. And what's the market doing? Just says, I don't care. Again, primary indicator here, secondary indicator here. Stick with price action. Price has to confirm. We'd have to see a big breakdown, maybe a move back down below the 20-week moving average with that negative divergence, and maybe some other signals, some other secondary indicators that start to paint a more bearish picture. But I think too many people look at whatever signal supports where they want the market to go. And maybe some think I do the same thing. I don't believe that at all. I try to look objectively at my charts. I look at all my indicators. If I saw everything piling on together, I would absolutely call a top. I did it in end of 2021 or beginning of 2022. But I can tell you one thing that's much, much more bullish right now than was at the end of 2021, and that's sentiment. And when I say bullish, I mean it's actually bearish, which is bullish because it's a contrarian indicator. And what I follow two things. I follow the VIX and I follow the equity-only put-call ratio. That's all I follow. I don't follow surveys. Who cares what people are saying? With the VIX, you've got market makers basically telling you what kind of risk lies ahead. I think that's pretty important, much more than somebody saying, oh, yeah, I feel pretty good about the market. Well, that's nice. So the VIX and the put-call ratio tells you what traders are doing when things are just getting too far. We're getting too stretched in one direction or the other. And it's got a tremendous history in calling tops and bottoms, short-term and long-term. Right now, both are telling me be long the market. So IWM, weekly, still got this, top we've got to get through around 211. No big deal there. Got this gap support that we're still looking at 200 to 202. Bounced yesterday. Let's see what happens today. Transports on the weekly chart. Actually, this is the daily. Actually, was the IWM daily? Yeah, that was daily. I'm sitting there talking about it like it was different. Here's the weekly. Actually, the weekly looks much better, doesn't it? Trading above the 20-week moving average, which is rising, and above the 50-week. PPO still positive. I mean, I see nothing but bullish things to say on the weekly chart for the IWM. Transports are maybe not quite as, it's a little bit more mixed here on this chart. Been going sideways for a while, but it certainly doesn't give the feel of a big downtrend like it does on the daily chart. The daily chart, we're focusing on this right here. Long-term chart, you can see we're actually putting in higher lows, and we're still well above the prior low that we saw last October 2023. So not bad action here. Chart of the day. If you're new to Earnings Beats, first of all, welcome. We love having you. Everybody, tell your friends, come in, join our show Tuesday, Wednesday, Thursdays in the morning, 9 a.m. every day. Check us out on YouTube. Make sure you subscribe to our channel, like our video. We'd certainly appreciate both. But by subscribing to our channel and then having your notifications turned on, every time we go live, you'll be notified. So definitely want to do all of that. Again, thank you for all your support that we've gotten from everyone over the years. We really appreciate it. But we are still trying to really build up this channel. And every person that comes in and watches is one more toward our goal of trying to educate the public. So anyhow, When you get to Earnings Beats, you can scroll down. First, you can check out our 30-day free trial. That's our paid service, but it is free for 30 days if you want to check that out. And then also, as you scroll down, you'll see an area where you can sign up for our Earnings Beats Digest newsletter, or a chart of the day is really what it is. 3 times a week, Monday, Wednesday, Friday, we'll provide 2 paragraphs in a chart. Something about the market could be the sentiment chart, could be a breakout on the major indices. It could be relative strength or weakness in some of the sectors that's concerning me. It could be an individual chart that's gapping up because of earnings. It could be an individual chart or company getting ready to report earnings. And I'm just giving you my opinion based on relative strength and some other factors as to what we might expect after the earnings are out. I did that actually with Lulu. And so I wanted to just show you, it's now open for business here. We're at 9:30. But let me pull up Lulu and see. And I didn't look to see yet whether they beat top and bottom line. But what I did say yesterday is that there was a lot of bad news built into this stock. And even if they came out with bad news, I wouldn't be surprised if we gapped up. Well, we got that gap up on Lulu. And so there it is. It was not a great looking chart when you look at relative strength or anything like that. It was just more of a gut feel. I mean, we're talking about a stock that was at 520 back at the beginning of the year, went all the way down below 300 just a week ago. And so I think a lot of bad news is built in. And once you get to that point where so much bad news is built in, if you have any good news at all, you're going to go up. And even sometimes you have bad news. And sometimes bad news can be the move that where you go up, where you think, okay, this is it. I didn't listen to Lulu's conference call, but they may have had some good things to say. They may have said, hey, yeah, things are weak right now, but we see better ahead. I don't know. Maybe some of you saw the conference call. If you have anything, post it in the comments. Love to hear what you have to say. But anyway, we are getting that gap up on Lulu. The one stock that I did say that I liked, and I actually bought a little bit of it going into yesterday's close, and they're reporting earnings. Actually, I don't need to do that. They reported earnings this morning. They had a big beat on the bottom line. I didn't see the top line, but they were flat. I saw them up a little bit early, and then they were down. They reported this morning, and then they were flat. But G3 Apparel, and it is down now. This is actually one of those, if they beat on their top line, this is one, if you're not in it, now that the earnings are out, and if they were good earnings, a move back up through that 20-day moving average. Let me pull up that 5-day chart. Well, right now it's still in its first candle, but I would watch this candle, and if it does keep going down over the first 30 minutes or so, and then we start to have a reversal, we get back up through that 20-day moving average, that could be a great entry point. It comes with a lot of risk, though, because anytime you're trading the day after earnings, there's going to be a lot more volatility. There's going to be a lot more volume. And so you are taking on more risk. But here's what we know about the stock. If I pull up a relative strength chart, you can see, first of all, AD line, very, very strong at a new high at yesterday's close. So what that means is that this stock has a tendency to close in the upper half of its trading range. So when it gets beaten up in the morning, a lot of times it will bounce back. So that's one thing to consider there. But look at the relative strength. Clothing and accessories, Lulu's in that group. You saw Lulu's chart. This stock is actually held up pretty well, and it's really not that far from its 52-week high in a market environment where clothing and accessories have been getting killed. So if we're starting to see a little bit of strength in this group, and this was one of the leaders, and let's assume, because again, I didn't look at the revenues, I know they beat bottom line. I think they reported earnings they beat by 17 cents. It was either they had a profit of 12 versus an expected loss of 5, or it was a profit of 5 versus an expected loss of 12. I'm not sure which one it was, but it was a pretty big beat on earnings. And if they beat revenues, my guess is that we rally off of maybe some morning lows this morning on this one. So anyway, that's certainly something to keep in mind if you are a trader, and especially if you're a trader that likes risk, because there is a lot of risk, but there's a lot of potential return as well. This one right here reminds me a little bit of Kava that we had in our trading room last week. Let me pull that one up and show you what happened there. So Kava, look at its relative strength. Very strong. The group it's in is very weak, but it was starting to maybe turn back to the upside. So what Kava did, it had a new high on the AD line, just like G3. Here was the earnings. Look at what happened. It opened down, it traded down in the morning, and then absolutely exploded back to the upside. Let me show you what that looked like on an intraday chart. I got to go back a couple more days here. We'll go back 10 days. So, yeah, here was the earnings right here. Big gap down, kept going down, and then it reversed. And look at what happened to the stock after it reversed. So they beat top and bottom line, but they got a negative reaction, but they're a leader and they have a strong AD. And so what happened? Big reversal. No guarantee that we're going to see that with G3 today, but it is something that I would at least keep an eye on. So got down to what, 28.30 something, 28.34. Now it's 29.33. I don't know if this thing's going to come back now, go back down this morning, maybe come back later, or maybe it just sells off. I don't have a crystal ball, but I do have a lot of experience watching this stuff, and I wouldn't be surprised to see a recovery by the end of the day on the G3. And I do own some of it, not a lot, but I do own a fairly small position. So sometimes I take a chance. And the thing is, I could have gotten into LU. Of course, which one do I pick? I pick the one that goes down, not the one that goes up, which is kind of par for the course. Seems like Murphy's Law. Anyway, that's it. Let me go in and take a quick look at what's going on in the market. We got the Dow right now down 41. S&P, we'll zero in here so everybody can see that a little bit better. Dow down 41, S&P up 4, NASDAQ 42. So there's that bifurcation still. Small caps down, mid caps down. VIX 1267. We closed at 1263 yesterday. This is one of the sentiment signals that I look at. This is one of my go-tos, the VIX. When it's below 13, I don't ask any questions. I want to be on the long side. That's the history of the market. When the VIX is low, stock market does its best. We just want boring action that just keeps churning to the upside. Frustrating the bears, anybody betting against this market, it's like a slow, painful torture when you're in a secular bull market advances. You just keep going up slowly, dip here or there, and then go right back up to an all-time high. VIX is low. Volatility during the day starts to move much lower. All of that combined can be very frustrating if you're on the short side, which is why I suggest not being on the short side. Just my opinion, but I'm going to remain long. There was a chart I was going to show you earlier, and then I was going to show it later in the show, and I can't remember what it. Oh, it was CLS. Let me show you this before we wrap up. So CLS, this was the recovery. So it had been going down, but it had a scooter of about 97. It was in the electrical components area, and the electrical components yesterday I was starting to see was bouncing. So what I did is I went in to I'm pretty sure what I did is I went into our strong earnings chart list. And what you can do is when you see an industry group you like, this chart list is a chart list that's already been filtered for our members. These companies that are on this chart list all beat top and bottom line in their last quarterly report. They are all somewhat strong technically. Either their group is strong or they're showing relative strength. Something about them I like technically. And so we've got a chart list here about 400 or 500 companies. And when you see an industry group you like, this is how simple it is. You go in, you view all, you go to summary. Right here, it shows you in summary, and then there's a search table over here. And all you have to do is type in electrical components. And there you got all the electrical components on this list. And then it is sorted in scooter order, and right at the top, CLS. And so I pulled it up yesterday at 10 a.m. when we were looking at it, at the start of the trading room. We're pretty close to the start of the trading room. And what I saw on a 5-day chart yesterday was this. It had come down, but it was above. It had moved back above its 20-day moving average, came down, and we're starting to see the electrical components moving higher. So at that point, it was literally at 53.60. I think that was my entry point, 53.60. And this was the one I said, hey, this one I think is good for a swing trade, not necessarily a day trade. So I am holding it right now. I did say that if it got up to 56.60, that would be like $3 or 6%. that it might be worth taking profit. So if you did, I certainly wouldn't worry about it. Wouldn't look back. 6% move in a day is awesome. I am holding. I thought about selling half. Right now, I'm still holding it. I'll see how the morning shakes out. My guess is, though, that we're going to go higher here, back up toward those highs. So I'm probably going to continue to treat it as a swing trade. But I'll be, thinking about that throughout the day. And anyhow, I'll try to remember to pass something along in the DMR, knowing that there are probably many of you that were in the trading room and maybe have the stock at this point. But for now, I'm holding on to it. What you could do is maybe just put split the difference. That's almost $3 gain. Maybe put in a trailing $1.50 stop. So at least you're walking away with $1.50, which would be a 3% gain. You could do that. Again, I'm just going to hold for now and just watch. Last thing I wanted to mention, going to be a change schedule is going to be a little different this weekend. I've got a family reunion out of town, so I'm going to be traveling actually later this morning. I'll probably be leaving around 11:30, and heading up north for our annual family reunion. I'll stop on the way, probably at a Starbucks along the way, and do a quick daily market report for our members. It'll probably be abbreviated. And then won't be doing the chart list, won't update the chart list this weekend, but we just updated the short squeeze, so there won't be a new one there anyway. There weren't a whole lot of companies reporting. So you've got a few, probably would add another 10 stocks to the strong earnings chart list this week. And there might be a little tweaking on the strong future earnings chart list as a result, but there really isn't going to be that big a change. So we're just going to wait until next week, next Friday, to update all of our chart lists. So we won't have that. I'm not going to do a weekly market recap video this weekend. I won't be doing a Fab 5 video this weekend because I simply won't have access to do that stuff. And I'll be on the golf course this weekend. So it's just going to end with family. It's just there's not going to be enough time. I'll be traveling back on Monday, so I'll probably do the same thing. I'll probably do a DMR a WMR, weekly market report, but it's likely to be very, very abbreviated. Probably won't be a whole lot other than just the basic, this is what the market did. Maybe show the big picture chart and maybe talk a little bit about a sector or an industry or something like that. But it'll definitely be abbreviated much more so than normal, so I can get that out a little quicker on Monday. Then Tuesday, we'll be back to our regular schedule with the shows on Tuesday morning and all. Everything should be back to normal at that point. So anyway, I just want to wish everybody a great weekend ahead. Hopefully stay safe. Let's get back in here on Tuesday. We'll see where the market is. At that point, we'll be moving into the Fed meeting. We'll have the non-farm payrolls to talk about, and we'll see where the market stands. But right now, don't bet against this secular bull market. Have a great day, everybody. Happy trading.